We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Ed Dowd, founder of Phinance Technologies and co-host of the Signal versus Noise podcast. Ed, thanks for joining me today. It's an honor to finally connect with you.
Thanks for having me on today, Tom. Pleasure.
So, Ed, you guys recently launched your first product, which was the U.S. Economic Report Outlook for 2025. You guys made the call in 2023 that the U.S. was heading for recession. What factors did you see as misleading within that call, and are they making a resurgence at this time?
Yeah, so we had a call. We have these early cycle indicators that had worked historically forever, and we made a call that there was a recession coming at the end of 23, beginning of 24. We weren't alone. There were a bunch of other economists, and we were wrong. And we asked ourselves, why were our early cycle indicators so off? And so we asked the question: are economic fundamentals forever changed, or was there some other factor? And we finally realized, after doing some why were we wrong? It dawned on us that there was a new economic variable that was temporary, that was injected into the U.S. economy, and it was illegal immigration. We've never seen in the U.S. 20 million illegals in a 3.5-year period dropped into the U.S. And then we've come to find out a lot of it was done with deficit spending. We've estimated it's been anywhere between 500 billion to 2 trillion. The U.S. deficits were running at around 8% to GDP, which is crisis level deficits. The last time we saw that was in the Great Financial Crisis. So it's come out since then that NGOs were the washing. This is how they washed it. They gave money to NGOs that then facilitated the transportation of the illegals from Central America to the Darien Gap through there. That was a coordinated NGO effort with U.S. taxpayer money. Then they'd get across the border. Then they'd be given housing. Then they'd be given some monies. And all along the way, we figured the all-in economic cost was anywhere from, like we said, 500 billion to 2 trillion. That stimulated the economy. And when you drop 20 million people into an economy with money, they spend it, and the velocity of money increased during the Biden administration. And this was a economic variable we've never seen, and it had floated a bid underneath the housing market, which was starting to roll over, but that was abated. We had a housing boom. We just put out a report on the multifamily housing debacle. There's a lot of multifamily housing units built, and that is going to be a problem. We haven't seen this kind of level of construction since the 70s. So everything that happened that made us wrong is unwinding. The Trump administration has stopped the flow at the border, and they're now going to start deportations, and that's going to have an economic impact. We're already seeing the housing markets roll over. All our indicators are rolling over. Today, new home sales just came out. They were abysmal. And this is just the cycle is going to unfold. It's going to be a recession led by housing. Housing is 20% of the consumption economy, and it's a big component of the CPI. Shelter is 36%. With the other ancillary housing services around that, housing is 45%. So the Fed is wrong on inflation. Inflation's coming down. Real yields are around 2%, and it's choking off business activity. And we're at the end of the cycle. And the thing that scares us a little bit is because of what they did during 23 and 24 with the deficit spending and the illegals, the hangover is going to be pretty big. And there's going to be, at some point, a dawning on the credit markets that there's going to be a big risk-off trade and a realignment of capital, which is all in risk assets at the moment and out of safe sovereign bonds. Bonds have had the worst bear market in 40, 50 years. And that was driven primarily by the Fed going from zero interest rate policy to 5.5%. They've lowered to 4.5%, but they're going to be lowering, we think, in the next several months as the hard data starts to unwind. And it is unwinding. Housing is a disaster. Housing is a slow rolling disaster. Same thing happened in 2008. The subprime market peaked in February 2007, and the crisis didn't really become apparent to people until the beginning of '08 with Bear Stearns, then Lehman.
So because of the, let's say, the slow rolling, let's say, nature of that bubble and the differences between now and 2008, you don't see this as a necessarily systemic issue like it was in 2008, right?
No, we don't see that. Now that could change if there was an oil price shock from the Iran-Israeli conflict. That would have made the chances of a systemic issue much higher, because people forget in 2008 it wasn't just a housing crisis. We had an oil price shock. Oil went from 90 to 147 between January of '08 and July of '08. That is a huge delta. It's always the delta in oil prices that caused the problem. And that literally collapsed the consumer economy along with the real estate bubble bursting. So if we had seen oil take off during this conflict and really break out above 80, our call would not only be right, it'd be more right than we would like. So we're not calling for a systemic crisis, primarily because the Fed has more tools in its toolbox than it did during the great financial crisis. And the leverage isn't as bad this time on the consumer balance sheet, but still it's going to be painful. And I want people to understand stock markets in recessions usually lose anywhere between 30 and 50%. In the dot-com bubble, which wasn't systemic, we lost 50%. We had a 50% drawdown in the stock market. And that was because valuations were so high. We had really high valuations in the stock market. We put out a free piece on our website analyzing the dividend yield of the stock market versus the dividend yield or the yield of risk-free treasuries. And it's as bad as it was during 2008 or not 2008, 2000 and 2001. So we have record high stock valuations, and if you buy at this yield, dividend yield, which is quite low, you will have bad 10-year forward returns. And I also like to point out, Warren Buffett saw what we saw in 23, 24, and he started accumulating cash. He was early like us, and he continues to accumulate cash. He's now he owns 5.5% of the T-bill market, which, why everyone's down on the dollar, everyone's down on the U.S. debt. In times of crisis, yields will go down, the Fed will cut, and Warren's just waiting for bargains.
Mm-hmm. Just before we leave that, let's say the whole immigration subject, obviously new home sales aren't the only thing that are taking a hit right now. I saw a chart this morning about that mortgage delinquencies are also, getting high and seemingly trending higher. But how did this also, this flux of immigration in, and now, the subsequent deportation of a lot of these immigrants, how is that affecting wages? I saw the announcement the other day that the blue collar jobs in the US have gotten the biggest hike in many years, and it was something like 2%, which doesn't seem like a big deal. But how is that also playing into these numbers of predicting a recession based on
blue collar wages can go up, but the problem is a lot of the employment statistics we saw in 23 and 24 were fraudulent or bureaucratic incompetence. There are about 1 million phantom jobs. That's all coming out during 2024. So President Trump was elected because the real economy was worse than the video game of the stock market and the GDP number prints. Mm-hmm. Real wage growth was -2% going into the election. The middle class was already in a recession. People are struggling. They have 3 jobs. That's why delinquencies are going higher. So the real economy, underneath this patina of fake stats, is continuing to roll over. And you take housing will affect the banking system, and there'll be a short-term credit scare. And so we see credit starting to dry up. Velocity of money started rolling over in Q1, and all the signs are there. we're just waiting for the capital markets to figure this out. We think yields have peaked. We think the 30-year bond put in a good low. The 10-year yield peaked at 480 in January, hasn't been back there since, and we think yields are just going to creep lower. The 3-month T-bill has been trending sideways. That if you see the 3-month T-bill start to move lower ahead of the Fed, that means the Fed is behind the 8-ball. So this is unavoidable. We think there's really nothing Trump can do. You got to let the endogenous factors in the cycle play out. But the good news is, right now, millennials can't afford to buy homes. All right, they just can't, and that's why home sales stink. There's no buyers. The good news is, as home prices come down, it'll rebirth the housing cycle and economic activity on the other side. So there's always, in a cycle, there's always the bad part, and there's the rebirth. And so there'll be a lot of home affordability as prices come down, and that'll rejigger the economy, and we'll get going again. Now, if it goes systemic, Katie barred the door. Again, we're not calling for that. If that starts to manifest, we'll call it out in real time. And that's why I want people to understand. We're not gloom and doomers. We're just like, this has to happen. It's actually good to have asset prices reset. It gives the younger generation the ability to enter. And if you're someone that wants to invest money in the stock market, doing it at these levels will give you bad 10-year returns. If you wait for a 40 to 50% haircut, you get a better shot of compounding wealth over time.
Mm-hmm. And I've heard you say that if Kamala had become president instead of Trump, that we would have had more of the same type of spending that would eventually show up in the currency. And as of this morning, I looked, we were at the lowest level on the DXY since early 22. And something that I've been trying to, let's say, separate and think through with guests on the show is to try to understand what the hangover is on the economy and the fiscal situation versus what Trump has caused within his term already.
Well, Besson wants a weak dollar, so they're job running the dollar down. What they don't understand is that the dollar has cycles that are huge. My friend Tim Wood, who's done great cycles analysis work on different asset classes, has identified what's called the 4-year cycle in the dollar. Mm-hmm. And that's from low to high to low. So from one low to the high to the next low is about 4 years. So last year, he was a lot of people were bullish on the dollar. He was saying as the dollar was rising, nope, we're going to go into a 4-year cycle low sometime in the first or second quarter of 2025. And here we are. And as long as the dollar, the last 4-year cycle low, according to his work, was 89.10 on the DXY. As long as we hold above 89.10 before we start the next bull market in the dollar, it's a bullish trend up and to the right. We had a bear market in the dollar low in the great financial crisis. I think we got around 78, 70, and 79 on the DXY. It's been straight up since then, up and to the right with cycles. So as long as we hold above 89.10, and I think we will, the dollar will start a new bull market. And I suspect the bull market will come as the deleveraging from the risk-off trade begins, because there'll be a dollar shortage. And we still have the highest interest rates globally. Everybody else is cutting because their economies are weak. And so the currencies will start to reflect that at some point. The euro is probably going to hit a high soon and roll over. So everybody right now is, super negative on the dollar, super short the dollar. And as long as it holds above 89.10 and bottoms sometime in the next couple months, the dollar is going to rip, I think. But, I have no evidence of that because we need to put in technically a monthly swing low. We don't have that yet on the charts. I will also say, though, that bonds, the 30-year bond is close to putting in a monthly swing low. So yields are starting to bottom or peak. Price is starting to bottom.
Right.
So price monthly swing low, on yields monthly swing high.
So this has more to do with, let's say, that behavior of in times of fear that people run to the dollar for safety.
Well, not run to dollar for safety. The dollar is, the dollar is very complex. But when there's a deleveraging event, or before the deleveraging event, the dollar will start to rise because there's a bid for dollars as people scrambled for dollar liquidity. You got to remember there's about 15 trillion debt out there globally, dollar-denominated debt. A lot of these emerging markets issued sovereign bonds tied to the dollar in dollars. They also, corporations in these countries also issue dollar-denominated debt. So a rising dollar is indicative of deflation.
Ed, how do we understand the importance of fiscal dominance in this era, and especially going forward here, and kind of tying that into how you see the Fed reacting when we do go into recession?
Well, it's going to be very interesting. So we've really had fiscal dominance since the great financial crisis. And that's been kind of the dirty little secret. After the great financial crisis, there was a decision made to solve the debt problem with more debt. Mm-hmm. So the private economy started to contract versus government spend globally, and we got crony capitalism as a result. And that's a lot of the populist movements you're seeing are in direct response to that. This crony capitalism makes those close to the printing press and government rich, and the rest of the populace is getting destroyed via inflation and lower wages. So that's why we're seeing this nationalist populist movements in not only the U.S. but all over the place. Fiscal dominance, Trump's plan originally, and it's changed unfortunately, but his original plan was to rejigger fiscal dominance into the private economy. So reduce the government spend. You're going to get a recession because of the fiscal dominance. When you curtail government spending, which was the marginal contributor to the economy, you're going to get a recession. They've decided not to cut the spending as much. So I don't know where they are on this, but you need eventually to reduce fiscal dominance and let the private economy rejigger. And that's through deregulation, tax cuts. The tariff wars are obviously incentivizing manufacturing coming back to the U.S. So that was his original plan. It's been tempered somewhat. They seem to be understanding that if you cut government spending too quickly, you'll have a recession that much quicker. I don't think they want one, but they're going to get one anyways from the housing cycle.
Mm-hmm. And what do you see as the catalyst in this rotation for asset allocators to start to, let's say, change their playbook that they've stuck to for the last 15 years?
Well, the asset allocation changed after there used to be a bond bull market, and since the Fed did the most historic rapid rate hike in the history of the planet, bonds have been in the bear market for the last 3 or 4 years. So everybody reallocated into risk and into away from bonds into equities. So everyone's on the wrong side of the trade. They don't know it yet, but they will. Once the hard data really starts to come in, and it will be undeniable, and there'll be some contractionary consumer spending hit. That's when everything realigns. And so we are looking at the housing market, and our thesis, if you had asked me in January of when we put out the report what my confidence level was, it was high. Mm-hmm. We've got 6 months of new data, and we're going to be putting out an update report to our big report. My confidence is even higher that this is coming. I suspect we're going to see, now that the oil price scare is behind us, we're going to see inflation starting to reflect disinflation to a deflationary scare in the next 3 to 6 months. We think we're going to see a CPI print below 2% before the end of the year. Mm-hmm. And that's going to be driven by the shelter component of CPI. And that's when the Fed's going to get nervous.
Well, that's exactly where I wanted to go with that next is, considering if CPI does come down, below 2%, and combining that with this idea, what that you said earlier about the Fed having more tools at its disposal, let's say right now, than they did at the beginning of the 08 crisis. What do you see as the Fed's reaction here coming into that recession? Well,
first of all, real yields are 2%. They should be cutting, but they're not. They seem to, Jerome Powell seems to believe that tariffs are inflationary. We put out a free piece on our website discussing that tariffs are actually deflationary. That it's going to cause a margin squeeze on corporations, which will then cause them to shed employees. That's coming. So they're wrong on that aspect. Jerome Powell also, I might add, in his testimony, I think yesterday, actually confirmed our thesis. He said the economy is slowing, and the effect of less immigration is starting to take its toll. So he agrees with us, but he's keeping rates high because he thinks that there's future inflation coming. They're going to end up being wrong on that. And so their first reaction will be to cut rates 50 to 100 basis points. People usually think rate cuts are bullish for stocks, but they're not bullish into an economic downturn because the Fed, it takes about 18 months for monetary policy to work its way through the economy. So they're already late to the party. They're gonna see a recession, and I want people to understand the Fed was cutting in 2000, and stocks they cut all the way down into 02. Stocks went down 50% in the face of rate cuts. Same thing in 2008. They started cutting interest rates in 07, and then we had a 50% clip to this. So Fed rate cuts at the end of the cycle are actually quite bearish because they're indication of fear.
Mm-hmm. And obviously their other tool, not only being rate cuts, but going back to QE, they're going to have that at their disposal and likely use that to the fullest extent that they can. How do you, or is there a market that is kind of sniffing that out? And is this also coinciding with the runoff or the end of QT right now?
Well, I would say that QE would be the last tool they want to use. They don't want to go to that. Now, if they go to that right away, we'll have to react to that. We might change our call that, you want to be, uber bearish, but we think the Fed is loath to continue to use QE until a last gap stop method. Having said that, if you look at the price of gold has been mysteriously just kind of slowly, stealthily going up. Gold is becoming money again. It's now a tier 1 capital asset on banks' balance sheets. That happens in July, but banks have been front running that. So they're remonetizing gold as money. So gold is going to be part of. There's going to be a coming monetary reset. There's going to be a new Bretton Woods, but I don't know when that's going to be. But certainly, gold is going to be part of whatever happens. Gold. There's the central bank authorities are signaling that gold is becoming money again. Banks can now, buy it. Physical gold. I'm not talking GLD, the ETF, or the futures. You have to have physical gold. If you have physical gold, you can lend against it. That's what tier 1 capital is. You can create money from gold now. Mm-hmm. After they took us off the gold standard in the 70s, they made gold a commodity. They're remonetizing gold. I think people need to understand that.
Mm-hmm. Ed, when we think about let's say the structure of the market and how QE actually, or what the effect that QE actually had on inflation in 2008, we basically had, I don't want to say no inflation, but asset inflation versus CPI type inflation. Then in 2020, when we had the direct injection of monetary stimulus, that seemed to be, at least in part, what caused the actual CPI type inflation that we saw. So is it possible that if we go back to, the fiscal type stimulus of QE, that we don't actually end up getting the CPI type inflation that we did previously?
Well, it depends. If they just do QE straight up, like they did in 08, it'll be asset inflation. Mm-hmm. If they do what they did in 2020, handing money directly to people, mm-hmm. we'll get. And let's also be quite clear. The amount of money they printed, then the government handed to people directly, was the most money printing we've ever seen in the history of the Fed. It was like something like 35% injection of money supply that then went straight mostly to consumers. If they do that again, we'll get inflation. And in fact, I believe that COVID, whether it was coincidental or not, COVID gave the monetary system and the governments of the world a great way to inflate away their debts. And we were rolling in 2019. We were having a global economic growth slowdown. Then we had COVID. Then they printed the money, and here we are. It literally saved the system. COVID literally saved the system, I think.
Mm-hmm. Well, we definitely can see, the slowdown in, repo activity, all kinds of symptoms there. But going back to this idea of QE, you said that Powell particularly, or you said the Fed would be loath to go back to QE. Do you think that this changes with Powell's term ending next May of 26, and whoever Trump's nominee is obviously going to be somebody that is more willing to work with him for his ends?
Yeah, well, look, it depends on how quickly the crisis unfolds that we think is coming. If they do QE and they go bazookas right away, that's telling you that it's worse than we think. And the markets, it'll be difficult to figure this out, but the markets may respond and just take off, or they'll take off with a counter trend rally, then roll over again until the money can actually work its way through the economy. In terms of Chairman Powell and the new guy, that's hard to say. We'll have to analyze it in real time. But I think, politically speaking, money printing it wasn't as well understood during 2008, but there's enough people out there now, and politically, QE is viewed as a bailout to the rich. And I think there'll be a political backlash if they go too far with that.
So, Ed, if this does play out as a, let's say, slower moving, grinding type, not necessarily crash, but grinding decline in the stock market, combined with this recession, what assets do you see really rebalancing? I know the long bond is something that you're paying a lot of attention to. What other assets are, in that situation likely to appreciate?
Well, in any kind of recession, risk off generally means risk assets will get sold. So we're just saying to people, especially large institutions, you want to rebalance towards U.S. sovereign debt. I know that's very controversial because everyone says that the U.S. is over and the dollar is going to implode and there's going to be a debt crisis. No one wants to buy our bonds. But when risk assets start selling and there's a real recession, you'll be surprised at how quickly people buy bonds, and the Fed will be behind you cutting interest rates, and there'll be a reallocation. So, we've been generally recommending safe assets and then, go back into risk when the news flow is so bad and it looks like the world's ending.
Mm-hmm. And right now, we're obviously seeing a ton of news from the Iran-Israel war. And, so much of the information that is coming out seems so contradictory. Do you think that this is a distraction at the moment? And what are you seeing that is happening as more of a cause for concern that isn't necessarily directly tied to the war?
Yeah, so I found the timing of this quite interesting, personally, because we do seem to be entering a risk-off environment, and so I was asking myself, well, one of the ways to cover up a potential systemic issue is to go to war. The good news is there was a lot of people on X and social media with their hot takes, getting into the nitty gritty of this and that. I couldn't care less. I said, I'm a markets guy. So I put out 2 posts about this, and I didn't even get political. I said, I'm watching oil. Oil obviously went up into the beginning of the conflict, but it only went up to the resistance level of a declining trend line. And I said, if it broke out above 80, we got problems. If it doesn't, don't worry about it. I let oil and the markets tell me, what's truth, because there's propaganda, in the fog of war, you're going to get lied to by everybody. Iran's going to lie. Our administration's going to lie. And the Israelis are going to lie. And why do they lie? Because they have strategic, things they want to get done, and they're not going to tell you the truth. It's just that's the fog of war.
The first victim of war is always the truth, right?
Yeah, and I don't expect them to tell me the truth, but I let the markets tell me what's going on. And it became apparent to me very quickly once oil collapsed again in the last couple of days that the Iran regime for now is intact. They're not worried. Somebody somewhere assured them that there's not going to be a regime change, probably the Trump administration. So they did not sink the ships in the Strait of Hormuz. So, and if there was any indication they were going to do that, the oil tankers on the ground that are owned by British Petroleum and Shell and all these companies would have called their CEOs, who then would have called the trading desks, and oil would have taken off. So that didn't happen. So the inside info players know the Straits of Hormuz are not going to be disrupted at the moment. So that to me indicates that this is, it's kind of like kabuki theater. Mm-hmm. There's a lot of posturing, but until oil tells me that there's a real problem, there's not a real problem. This is, granted, dropping bombs, people's lives have been lost. I'm not trying to downplay the conflict, but in terms of how it affects the globe, this is a nothing burger at the moment.
Yeah, it's so interesting to understand how the markets really didn't react to the news, and that's exactly what I wanted to also ask you about. Is this, obviously you explained how the oil traders kind of know and get their information here. But obviously, gold, the dollar, the stock market, they all, reacted opposite basically to the way that many people would have expected this to happen. So do you think those markets are basing their information as well off of the way that oil reacted?
I think so. Look, inside info globally is transmitted very quickly. And again, the Straits of Hormuz is a simple example. There's oil tankers there, and the captain of the ship, if they started, if they would have seen Iran, putting out the ships and sinking them, they would have called their trading desks. There was no indication of that. No indication. Well, markets tell me more than what my leaders tell me or other countries' leaders tell me.
Mm-hmm. And it's wild to see how many times, any of these X accounts did pronounce the Strait of Hormuz that it was either closed or it was going to be closed. And this happened, countless times, and yet it's still open.
It's still open. And again, look, a lot of people probably wanted me to speak on this Israel-Iran conflict. Mm-hmm. I like to pause and think and not react emotionally. Mm-hmm. I put my emotions on hold, and I said, let the markets tell me the truth. And the truth so far, right now, this could change, yep, is that this conflict is over. Mm-hmm. Effectively over.
And it's quite interesting to me too. There was actually a Truth Social post put out by Trump that was basically threatening any of the other leaders of the world raising oil prices. And, I think that is kind of telling as well, right?
Well, that I saw that post and I thought it was ridiculous because he was, I'm watching you. Trump has no control over the markets. Short term, he can, if he, his tariffs, he did because he created his own sell off, and then he could take away his own. He could cause a rally anytime he wanted. But with the oil markets being much more global and real time, threatening, people like that I just thought it was hysterical. I thought it was kind of like a ridiculous comment. The price of oil didn't go down because Trump said anything. The price of oil went down because there's no threat.
Yeah, exactly. Well, and I mean, it's not, I wouldn't assume that all of the other, world leaders or OPEC producers are glued to Truth Social to try to understand what they should or shouldn't be doing.
Correct. Look, if you're, and traders are traders. If they're short oil and oil starts going up, they're going to cover their short and add to the short squeeze. So like Trump can't do anything about that.
Mm-hmm. Ed, can these oil price shocks actually be deflationary if the delta is too fast because of demand destruction?
Yeah, absolutely. So what we saw in 2008, oil went from 90 to 140, as I said earlier, 147. Mm-hmm. What it did is it caused CPI to temporarily go up. So June, July, and August, or actually May, June, July, August, CPI went up. And then that caused a price shock to consumers. Demand fell. And once that became apparent, we went into a deflationary death spiral pretty quickly. Mm-hmm. So in the short term, oil price shocks are inflationary, medium term deflationary. They just cause massive consumer demand destruction.
Ed, something that I've really tried to understand through my time hosting the show and talked about a lot with guests as well is trying to figure out where to get, let's say, quality information here. Obviously, X can be useful. It's kind of a double-edged sword, just like many of these other platforms or, let's say, news sources. But we just talked so much about what the oil market was doing, for example. You've been on the cutting edge of a lot of, let's say, these trends and the idea of sourcing truth over the last, especially 5 years, let's say, where you've been more prominent in this. What are some other sources that you use or pay attention to that, in essence, tell you the real story of a lot of these situations?
So, unfortunately, let's talk about X for a second. Twitter, years ago, when I got on Twitter in 2013, and I found that Twitter back in the day had really good sources of information that were in direct contrast to the mainstream media, and often they were right and leading indicators. That's been polluted because the intelligence agencies, PR firms, political PACs, they now manipulate social media. And so you don't know it's harder to discern the truth on X. So you have to find trusted sources and verify everything. When I see a post, I want a direct link to a source or something. And before I'm not always, sometimes I retweet stuff that's wrong, but I try to make sure that I'm doing my best to, post things that are as truthful as I believe. What we do at Phinance Technologies is we look at huge metadata. And so that's how, during the COVID days, we figured out, looking at all-cause mortality, that something was way off compared to the stories we were getting from the official health authorities. And we're doing the same thing with the economy. We reverse engineered why we were wrong, and now we're looking at the big data. We put out a new tenant report about a month ago, a multifamily housing report. We're putting out a single-family home report. These are different reports from the big one. They're available on our website. We just look at the big data, and we look at leading indicators that are part of our early cycle indicators, and everything's rolling. So despite what you're seeing, from the Trump administration and economists, the underlying picture is a different picture. And asymmetric trades like this don't come that often. And asymmetric, I mean, we have information other people don't seem to have. We're not the only ones seeing this. I mean, Lacey Hunt, another economist, is seeing this. Daniel DiMartino is seeing this, and this is what we do. We look at big data, and we try to see trends ahead of everybody else.
Mm-hmm. Well, of course, having an informational advantage is key to being able to understand these trends early and position early. And I've heard you talk before about Martin Armstrong saying that capital moves before armies move. So do you think that this could be another leading indicator of more conflict within Europe, and that this is also kind of tied into the reason that so much gold came out of the LBMA at the beginning of the year here?
Yeah, I think we got to look at what's going on in Europe, the Ukraine-Russia situation. Europe has a big demographic problem. They have a debt problem. Something's going to happen in Europe, and capital moving into the U.S. via the gold is a disturbing trend. And Europe is worse off than the U.S. in terms of their populations. Their populations are facing an onslaught of massive immigration, pension issues, and the politicians and NATO don't want people to rebel against them, so they need to create a distraction. War is always a good distraction. So something's brewing, and I don't know what, but it's ultimately not good.
Do you think that really they want war to cover up how weak their economy and that currency system of the euro actually is?
Yeah, look, the euro, my partner Carlos Allegri has looked at the long-term viability of the euro and demographically, and that's why they've been doing their best to import these illegal immigrants into Europe, because demographics are destiny. The only way to prop up a pension system and the debt is by, importing economic units into your country. So the euro is not a question of if, but when the euro disbands. And again, calling the timing on that is difficult. Could be 5 years from now, could be 2 years from now, could be 10, but it's unsustainable.
Mm-hmm. Well, of course, demographics equals destiny. China obviously has a major demographics problem as well. Do you think that is the biggest risk to their ability to execute these long-term plans that they have, that they're so good at?
Yeah, so coincidentally, China hit a demographic peak in 2020 and it's rolling over. And that's what's caused a lot of the real estate problems. If you look at the Chinese bond market, it is in deflation mode. They're going through a deep recession/depression. So they have a demographic problem, and they need to create distractions to keep themselves in power. War is one of them. Right now, as we speak, the Taiwan conflict could rear its ugly head at any moment. We have a problem with Japan. Japan's hitting another really bad demographic decline, worse than the one they had previously. That's just started. And South Korea is a disaster. So we have China, South Korea, and Japan all in demographic downturns with immense amounts of debt. That's a cocktail for either war or a financial crisis that spreads globally at some point.
And of course, they seem to be more averse to bringing in immigrants, like, let's say, Europe, the U.S. or Canada is as well. Is that a fair assumption?
Absolutely. People in America think all Asians are the same. They're not.
Yeah.
The Japanese hate China. The Chinese hate the Japanese. The Japanese don't like South Koreans. The South Koreans don't like the Japanese. So there's a lot of brewing, and Japan does not like outsiders. That's just the way they are. Mm-hmm. And Japan is not going to be importing anybody. They got a problem, and their debt to GDP is 260%. This sovereign debt crisis that's been brewing for the last 10 years was always going to be eventually a currency crisis, because the release valve on debt is currency. And Japan right now is at kind of the end game. They're caught between saving their own economy or blowing up the yen carry trade. And that's what is going on over there. And Japan gets a lot of pressure from the U.S. They get a lot of support from the Fed. So they're being pressured to kind of sacrifice their own economy. So they have an inflation problem there. And we'll see how long that, they're caught between saving their own country or the global financial system. So we'll see how long that lasts. Right now, again, that's a black swan event that could happen at any moment. It hasn't happened yet. When it happens, don't know. The problem with this deep worldwide recession we're calling is that could start a daisy chain of other bad things to happen. We're not calling for that, but the risks are there.
So, Ed, there's countries that are starting to look at imposing or have already imposed taxing unrealized capital gains or home equity taxes, for example. Australia has already imposed a version of this. Do you think that this is showing the level of desperation that these debt-laden countries are in?
Absolutely. Look, at the end of this kind of situation, fiscal dominance, there's a mad scramble to steal more money from the taxpayers. And taxing capital gains is a disastrous idea. It'll cause even more of a economic downturn because people will go into debt to pay taxes on things they have no cash flow. It's the most insane thing I've ever heard. But this is, to your point, it shows the level of desperation out there. And the elephant in the room is the interest on the interest.
Yeah, and I mean just expanding on that idea a little bit. Trump came in saying that he didn't want to have bigger deficits. I've heard you say that you think Doge is going to make more of an impact here than they let's say initially did, and yet we're at this place where the big beautiful bill is something like the third largest deficit in history. And I think that is just part and parcel of this debt equation, this interest on the interest, right?
Yeah. And look, I was very optimistic about Doge. That was early days. I'm changed my tune on Doge. Mm-hmm. Elon is gone. There was obviously falling out between Trump and Elon. There seems to be a change of heart from deep cuts to expanding the debt. But unfortunately for Trump, and I don't think they realize this, the Biden administration accelerated debt creation a lot in 2024. And even though this big, beautiful bill is going to increase the debt, it's not doing it at the same rate. So it's the rate of change that matters. So they're still going to get their recession. What they should have done is really just taken all the heat up front and blame it on Biden and really cut, but they didn't. So they've created a problem that's going to have to be dealt with down the road.
So, Ed, you and your partner have launched the macroeconomic alternative hedge fund here. Why is it alternative, and what types of assets are you looking at?
We haven't raised capital yet. We're still trying to find a good partner that would get 20% of the company. It's a macro futures fund. We reflect all our bets with equity futures, bond futures, currency futures, and commodity futures. And so it would be a CTA, commodities trading fund. Haven't raised the capital yet. And interestingly enough, had we raised the capital when we wanted to, because our models were wrong, we would have had a 20% drawdown. So it's fortuitous that we didn't do that. But now, that we understand why we were wrong, we'll continue to look for a partner. But that would be the way we would express our macro views, would be through this quantitative early cycle indicator model.
I had a conversation yesterday with a gentleman, and he was saying that in let's say a worldwide type recession or depression, that commodities, he's actually not very positive on commodities. Is that something that you would share his view on?
In a deflationary depression, commodities go down, which is just less demand. So yes, but low prices. The solution to low prices is low prices themselves. The solution to high prices is high prices themselves. Because eventually, high prices destroy demand, low prices destroy supply, and they always there's boom and bust cycles. I mean, this is what cycles are. We can't get away from cycles, and it's the nature of the collective human decision making is kind of like an organism and there's cycles to it. It's just like nature. Anything in nature has a cycle. Economies have cycles. The problem is when authorities try to disrupt the cycle, they make it worse. They can delay it, but the hangover is worse.
Right. Excellent, Ed. Well, I appreciate you walking us through all these different topics. Is there anything that you'd like to leave our listeners to think about before we wrap up here?
Yeah, just if you're interested in our research, financetechnologies.com with a PH. You can buy the big report. You can buy some of the follow-up reports. We're going to be putting out another report in a week or two, the single-family housing conundrum. So we continue to put out research. Some of our research is free. It's on our resources page. So I encourage you to check it out if you want to understand what's really going on. We're going to be, I'm convinced we're going to be proven right big in the next 6 to 12 months.
And of course, for anybody that wants to follow Ed on Twitter, he's an excellent Twitter follow as well, at Dowd, D-O-W-D, Edward.
Yes, thank you.
Thank you so much for your time today. Really appreciate it.
Thanks, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.